All right. It's perfect. Okay, welcome everybody to our webinar today. I really want to apologize. We were having some technical difficulties and computers were not connecting and microphones were not synchronizing, and we had a little bit of an issue with that. But fortunately enough, we are ready for this one. Today, we will be talking about restaurants. Last year, we did a series on commercial properties, and we decided that for the 2023, we wanted to do a little more detail. We wanted to go into more detail and more specific topics on this series. So we have several different ones throughout the year. This one is the first one, is about restaurants. And then we have another ones on multi-family properties and warehouse properties. And then we have even the bigger one is about strip malls. So we have an expert here that can help us out going through the information on, what the best practices are for acquiring those types of properties. Again, today, the one for today is about restaurants. And I want to introduce you to Luis Olvera, who is going to be the presenter today. He has over 18 years of experience in several different things, international business, one of them, contract negotiation, development of subsidiaries, export, import. He's also have been working over the last 15 years in the commercial real estate. He's an agent, and he's been working here in Minnesota for over 15 years. So all the information that he's going to share has been gathered throughout many years. So I think we're very fortunate to have somebody like Luis with such big experience he makes this feel very easy, but believe me, it takes a while to learn all this information. So to our members, we appreciate your participation, and believe me, this is gonna you're gonna have a big benefit. You're gonna have 3, 4, maybe 5 steps ahead once Luis go through the presentation today. And anyways, I want to let Luis with you, who can start the presentation. Welcome, Luis, and thank you for helping us out.
Fabio, good afternoon. Thank you very much for the presentation. It is very nice and happy day for me to be able to share, as you mentioned, all the information that I've been gathering throughout these years of commercial realtor. Some kind of housekeeping that I would like to give you guys and girls. Do not write anything except what are some ideas, but don't try to write what is it in the transparencies, because everything has been or is going to be recorded. So once that we finish, probably 2-3 days, you can go back to the Latino Chamber, and then you will find a link and you can download all the transparencies, or you can write me, text me, call me, and I will be more than happy to send them to you. Obviously, with the recording is going to be voice, but if you want the transparencies, please feel free to contact me. Today is going to be a lot of information, so please sit down, relax, breathe in, and I will promise that your brain is going to have a lot of information, okay? So having said that, again, relax and take a brief breath, and here we go. Restaurant is the topic of today. This is a very small guide. We're going to talk more in depth about these different topics. We're going to start from the big picture, what is a restaurant, to the metrics of a particular restaurant. So it is very interesting to know what is a restaurant. And the restaurant comes from a French word that means provide for food. That's very interesting definition. And then we go to the types of restaurants, and I found that 3 are the most important differences of restaurants: the quick service, the full service, as the fast casual. The quick service is like McDonald's, Wendy's, etc. Full service is 3, 4, 5 star or 1, 2, or 3 star Michelin, in which you sit down, you can have cordials, wine, you can have cognac and brandy, etc., and liquor, and 1, 2, or even 3 waiter or waitresses can serve you. And then the hybrid, which is a combination of the above, is what is the fast casual. I think that this is like a jump. It's like Culver, in which you go to the front, you ask for your meal, you go sit down, and the waiter or waitress brings you your meal. So that is the main 3 classifications of restaurants. I found some that they classify restaurants in 21, 25 different aspects of a restaurant. They go like if it's only seafood, if it's only wine, if it's only wine and cheese, if it's only bar with tapas, etc., etc., etc. But again, these are the first 3 classifications of what's a restaurant. Going down into the rabbit hole, I found out that there are more than 1 million restaurants in the United States, and there are more than 16 million now people working for them. Very interesting is that there are more than 100,000 chains of restaurants in the United States, and because of the pandemic, the sales of a restaurant has diminished in the last 2 years, only $334,000 million. That's kind of a chunk of money. Normally, it was going to be $1 trillion. The trend was signaling to $1 trillion, but unfortunately came the pandemic, and now we are back to $600-ish thousand million. Hopefully, by the end of this year, we can get at least to the same level of pre-COVID. That's a very interesting information. What do we look when we go to a restaurant? Basically, 4 things, excuse me. We are looking for somebody that is friendly to us, that the food is going to be consistent every time, the same quality of food, memorable atmosphere or experience of what we had in that time that we were in the restaurant, and obviously, very important, efficient and good, excellent customer service. In this kind of atmosphere, the customer is always right. If the client says this wine is rotten, yes, sir, it's rotten, let me change the bottle, let me bring you a new one. If the meat is hard or not cooked enough, yes, sir, you are right, let me bring you another one. So that is really basically the nitty-gritty of having a restaurant. Service, 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 okay? Having said that, let's dive into the nitty-gritty here. Here we have a big animal, we call it a standalone. As you can see, it has a drive-in, and we are going to buy it, okay? And I will be kind of mingle and commingling the topics, because this particular restaurant that we are looking here can or cannot have equipment. I am going to talk about the differences in buying it with or buying it without, okay? So, imagine that it is the real estate by itself. It is an empty shell. Are we going to buy the land? Are we going to buy the bricks and mortar, okay? There is no restaurant in place, just a building. As in any other building, we are going to have Number one, a commercial realtor, please, please, please do not have a residential, because with all the respect to my colleagues, they are not specialized in all the things that we're going to talk about today. When you mention to them the LOI, the capitalization rate, the cash on cash, the environmental inspections, believe me, not all of them know about those terms. So once that you acquire a commercial realtor who happens to have an army of people that is going to support all the services needed, then you proceed and start to look for restaurants. At the same time, I highly, highly, highly recommend you to go to the banker, obviously a commercial banker, that is going to give you a pre-approval. He or she is going to ask you for at least, now because of the COVID, 3 to 4 years of income tax declarations, the last year or 6 months of bank statements. If you have an office or a company, the last 2 or 3 years of taxes of the company, bank statements of the company. He might go to the Better Business Bureau to see what kind of a score your company has, and obviously he's going to pull in a hard pull your credit score. At the same time, as I was commenting, you start to look or to tour, that's the term that we use. You don't show in commercial, you tour properties in commercial. And by the way, we're very lazy. We work only 9 to 5, Monday to Friday. So don't even think that you're going to have a tour on Saturday afternoon or Sunday morning because you don't work. Sorry, you have to go to a tour on Wednesday at 11 o'clock, because that is the time in which the listing agent is available to have the tour to you and your client. You meaning your realtor. The realtor listing agent, 99.9% of the times, is going to be present in the property and is going to tour you the property. That is why it's very important to keep in mind that it's going to be Monday to Friday, 9 to 5. Let's say that you like that building that we have here. What is next? The letter of approval is running its course, and then you and your realtor write a letter of intent. A letter of intent, my friends, is a document that is not binding, is not legal. As its name says, is just an intention that you are going to do something. I will like to have tacos with you on Saturday. I will write a letter of intent. But if it's a tornado, I am not going to eat tacos and nothing is going to happen. Same here. You are just expressing your intention. You negotiate that intention with the listing agent that obviously is going to go to the owner. And in my experience, sometimes, my friends, that can take up to 3 months. So commercial, as you are learning, is not a 60-day buying a house type of deal. It can take 11, 12 months, even more than a year. So keep that in mind as well. Be careful with the seasons in Minnesota. That's another very interesting thing to take into consideration. In the letter of intent, you are going to put all the possible contingencies that you can think of. For instance, you are going to see the roof. If the roof needs repair, guess what? We're going to negotiate that repair of the roof. If in the case of a restaurant that has equipment, the hood is not working, well, guess what? We can negotiate that the owner will repair or replace the hood. The same with equipment. Is he going to add value to the real estate for the equipment or not? So see, I am starting to commingle the topics here. If it is empty, we don't have any problem. But if the place has equipment, be careful because you are going to negotiate the equipment. And also be very, very careful how old is the equipment, how old is the roof, how old is the air conditioner, how old is the heater, etc., etc., etc. Floors, walls, furniture, very important. You don't like that furniture, you know what? I'm not going to buy you that furniture. So all of these things have to be negotiated prior to make a purchase agreement. Very, very important. That's why it can take 3-4 months just to negotiate the letter of intent. Let's say that we have it negotiated, we proceed with the purchase agreement, which is going to be 90% accepted. Careful here, you have to ask your realtor to ask the banker for environmentals. Is the bank prerogative to ask for environmentals? What is that? Phase 1 and phase 2. I have had situations in which the restaurant was located 3 blocks from a gas station that was in 1937. Guess what? 1937, the tanks were not as good quality than the tanks that are today. So most likely leaking happened, and guess what? It might be polluted the underground of your restaurant. Careful, careful, careful with phase 1. And God forbid, if the ground or dirt it's contaminated, you are not going to get a loan if you are not going to make a mitigation system. To give you an idea, we are in the process of making a deal in Wisconsin, and the mitigation system is going to be $120,000. So you have to take that into consideration. I'm not saying it's going to happen, but what about if? Okay, you perform all possible inspections. We have had inspections in which we have hired or contracted a geologist. We have contracted a engineer for structure. We have contracted a consultant for the Historical Society of Buildings in the event that the building is historical. And God forbids if that is the case, because this society is extremely to the extreme picky to say, you know what, I don't like the knob of the door that you're going to replace because it's not the same material as it was built in 1877. And guess what? That material doesn't exist anymore. So be very careful when you are going to buy historical buildings. You proceed, after that, you proceed with due diligence. We're going to enter in more detail. Right now, I'm just going to tell you that there's 3 of them, which of course my colleagues, presidentials don't know how to do it, where to go, and what is this. This is the physical, financial, and fiscal due diligence. We also have to search for permits. If you are going to have a restaurant full service and you are going to serve hard liquor, be very careful, because sometimes each city has certain numbers of licenses per year. And it doesn't depend upon if you are in Minneapolis or in Cochise County. The city says, you know what, this year is going to be 15 licenses. And if you are number 16, tough luck, you have to wait 1 year. Okay, so be very careful with the licenses. There is the other kind of license, which is for beer and wine only. That is cheaper, and you can get it a little easier. Here again, careful, careful, careful for insurance, liability insurance. Remember the horror stories that has happened when a guy or a girl gets drunk, gets out of the bar, hits somebody, God forbid, kills that somebody, and the guy or the girl, guess what? Sues the place, in this case your restaurant, because you allow him or her to drink more than the allowed. Also, another very important thing is liability insurance. If somebody trips inside your restaurant, it's going to sue you for $1 million because the leg is the most precious leg in the world. So be very careful with insurance in restaurants. Search for all permits. We talked a little bit about that. You have to visit the marshal and the police department. God forbids And 10 years ago, they were selling drugs in the bathroom, and that restaurant is in the eye of the police. Or it was a fire 3 years ago, and because of the owner didn't want to spend money in the permit, Juanito fixed it, he didn't pull the permit, the marshal comes, and guess what? You have to redo all of that, and in the meantime, the restaurant is going to be closed. So be very, very careful with that. You have to start involving, obviously, the title company to see if there is any clouds in the title. What is a cloud? A cloud is something that does not allow the title to be transferred. For instance, if the property has what is called a mechanical lien. Let's say that the owner fixed the doors and he never paid the carpenter. So the carpenter sued the owner because he didn't pay the doors. Well, guess what? The title cannot be transferred because it is in litigation, that situation. If and when, after another 6 months, is satisfactory, thanks God, let's go to closing. And then, God forbids, everything goes fine. Another thing that I would like to mention, when we go to the to buy the property, my computer just happened here. In this approach, when we're going to buy the building, we have to do at least 2 equations or 2 analyses. One is called the capitalization rate, and the other one is cash on cash. Capitalization rate is when you determine how much or what percentage of your investment is going to be capitalized per year. Normally, it's calculated by net operating income divided by the market price of the property. 6-8% is the normal number. Cash on cash is the amount of money that you put in as a down payment and what is the profit that you have at the end of the year. If you put 100,000 and at the end of the year you take out to home 10,000, that means cash on cash 10%. Simple. Well, remember, here are the different programs. Of course, there are more than 1,000 programs, but these are the most important ones. Numero uno, you can buy with Social Security that building or with IT. Very nice. However, with Social Security, as you can see here in the graph or the chart, there are more programs available than 14 or IT number. Numero uno, the SBA. Again, the SBA does not loans money. SBA guarantees the loan. And therefore, for restaurant purposes, building, you can have 10% down. It's available for social, not available for IT number. You can put 15% down. That's another problem. And now talking about the business itself, you can have loan which some institutions will package into the big loan. In other words, if the building is $1 million and you need to buy $100,000 for equipment, your loan is going to be for 1.1 million. That is very, very interesting. Some banks do, some banks don't like. Why not? Because the equipment will depreciate very fast. And then in case of bankruptcy, what the bank is going to do with the equipment. But there are other institutions that only finance the equipment. So be very careful as your realtor to find you that, and it is available. Another one option is there is a company in town which you can rent with option to buy, or you can buy in long term. Fabio has a question at this point. Yes, Fabio.
Yes. I was looking at this, the difference between the Social Security and the IT. When you said that it's 50% now and it's available if you have a social security, but if you don't have, if you don't have a social security, you only have an 19. So what are the options then?
Because of the IT, the bank is going to have more risk. Therefore, the bank will ask you for down payment, as you can see in number 5, 20, 25, or 30, it is available for IT.
Okay,
That is the answer.
there you go, okay.
Mhm. Yeah. And and of course, the normal loan is 20 years fixed rate. 5, 10, and 15 can be adjustable rate. And it's very tricky, especially nowadays. Like if you remember 3, 4 years ago in commercial, careful, commercial interest rate was 4.5. About a month ago, I asked my loan officer, it was 8%. Actually, it is not a secret, but 2 deals have been canceled because of interest rate. When you have that much money to pay every month for mortgage plus interest, again, cash on cash and return on investment is out of the question. You will be better off buying treasury bonds at short term, it's giving you 4%. And you don't have to worry anything, you have just to go fishing. And this one, you have to wash the dishes every day. I wake up at 4 in the morning. So these are the main programs. We can talk 2 hours about this chart, but let's continue with more information. It's a lot more information to go through. Let's talk about equipment. Again, there are institutions that give you long-term, 5 years to buy it, 1 year to buy it, etc. You can package in or with other institutions, or of course, you can buy it by yourself. That's not a problem. As you can see here, the computers, you can even ask, there are some banks that can give you this kind of infrastructure because they want to work with you. Why? Because all the sales that go through this computer or software, guess what's happening? Goes direct deposit to the financial institution. So very clever, no? So be very careful with the equipment. If the restaurant has already the equipment, ask your realtor to have an inspector for restaurants. He or she can go and certify about the fryer, about the hood, which are the 2 main things, or the walk-in. If the bathroom is ADA, if the walk-in is in good service, you can check it out. You can hire an inspector for walk-ins, okay? So be very, very careful with inspections. As I mentioned before, have all possible inspections available. And yes, you have to pay for them. You as a buyer. The seller is not going to pay 1 penny of the inspections. You can negotiate your repairs and replacements, but inspection per se is your money. So now let's go and make a due diligence. That's where really we make our money, no? In addition of all the services that I have been mentioning in the last 30 minutes. If it is a business that is ongoing, obviously you have to check the structure, your assets, you have to see how old are they, the furniture, the equipment, etc., etc. Environmental issues we talk about, insurance we talk a little bit about it, the roof we talk about it, the foundation we talk about it with the engineer, a structural engineer, all the mechanicals, all the inspections, are utility bills paid off, are they current, etc., etc., etc. That is the first due diligence that we do. The other one is the employees. If they are happy, I will have an interview with each and all of them. Are you happy? What is that new owner would like to do different to make you feel happier in this environment? Or if not, hey, you know what, Johnny, next month is your last month. Nice to meet you. And obviously tax information, not only careful here, very, very important. You have to check the taxes of the state, local and municipal. Sometimes the federal are fine, but the other ones are not that good. You will have a lot of surprises there, my friends. And then obviously the last one is everything that is in relation to the financials. You have to check the general ledger. Remember, the company credit report is basically based upon the BB, Better Business Bureau. The same as businesses have also their own credit. And you go and check the credit of the company. Financial statements for the 3+ years. And also, once that we're talking now as far as financial statements, let me tell you, you have to have for either your commercial realtor or you are an accountant. By the way, I am not an accountant. I cannot give you accountant advice or taxes. I cannot give you any tax advice, okay? I'm just going to tell you my opinion, but it's not an advice, careful. In terms of analysis and interpretation of financial statements, there are basically three different groups to do that. Whether it's the liquidity, the leverage, or the profitability analysis. What is that? Well, the liquidity is to determine how the company gets involved with banks and creditors. The normal, good, healthy ratio is to have $2 in assets, $1 in liabilities. That's a very, very healthy company. Yes, it depends upon if it is capital intensive, if it is a service company, etc. But in general, in a restaurant, if you have $2 in the bank, in the cashier, in CDs, in bonds, you owe $1 to vendors, to providers, etc. Very healthy company. Leverage, how well the company pays precisely the liabilities. Everything is up to date. There are uncollectibles that they are suing you, etc., etc. And obviously, the last one is the profitability. How profitable is the restaurant? And we are going to go in depth just to mention 5 metrics of how you can control the profitability and you can see the profitability of your restaurant in this case. And it's in general terms how well the company is making profit. In other words, for every $1 in sales, you have 5 cents in profit. There is another analysis that is called the DuPont analysis. That is not the return on investment, but is the return on all the money that you have in the account of capital. That's a very in-depth analysis. Very few people do it, and it's really state of the art. The DuPont analysis, you can Google it, and it's really scary. Now, let's talk a little bit about renting. And there are, again, many ways to skin the cat. And the first one is if we find this, as I call, empty shoebox. Several things we have to look at this place. Numero uno, if it is ADA. As we can see, there is a tube in the bathroom and a wide door. That indicates that is ADA. We see here that is unisex. Immediately, let's ask the city if he is going to require one for a man, one for women. Very careful, because to make a bathroom is going to be $40,000 in this particular space. If we go through that door in the back, numero uno, is there walking? Walking, as you know, is a room that is done for preserving food at certain temperatures. It can be frozen or it can be 37 degrees, 40 degrees, depending upon what your license. Very important, you have to have a license of managing food even before thinking to make a restaurant, guys. You can get it in one Saturday. I believe it costs you $200, but it's numero uno. You cannot even start having a restaurant if you don't have your license, okay? In this one, what else is lacking? Well, all the furniture all the cameras for security, the counter and the infrastructure that we talk about to swipe the cars. The flooring, maybe it's okay, maybe not, maybe you want carpet, etc., etc., etc. It has sprinklers, very important. I have had one experience, guys, that the restaurant did not have sprinklers. And the owner wanted to negotiate that. Guess what? It was $75,000 to put this sprinkler system, and he wanted to put 25. So that's itself, it took us out of the game. So careful, careful, careful. And again, a commercial realtor is going to look for these little details that at the end of the day makes big differences. Time and money is of the essence. Okay, so we like it, we love it. We went to the city, they did not require another bathroom. Everything is fine and dandy. What kind of a rent are we going to have? Well, here we go. The first kind of rent, and if you see at the bottom, restaurants, is what is called the triple net. The triple net stands for the three nets in the lease: property taxes, building insurance, and common area maintenance. In this particular case, believe me, this is in a strip mall, so therefore the strip mall will have to have maintenance of the parking space, the lightening of the parking space, the removal of the snow, the taking care of the gardens or the plants or trees, etc. All of those are the common area maintenance. The owner will say, okay, guys, I spent $100. There are 3 spaces. Every space are 10 square feet. Well, the CAM is going to be $10 each. 10 times 10 is 100. And then the owner or the landlord will say, you know what? Today's rent is $30 per square feet, triple net, with $5 per square foot of CAM. So let's start using our brains here. Don't use calculator. The brain is better than a calculator, believe me, if you know how to use it. If it is $30 per square foot and $5 CAM, the rent is going to be 35, correct? 35, and let's say that the space is 1,000 feet. So you multiply 35 times 1,000 is 35,000. Let's say for sake of conversation, that is 36,000. 36,000 divided by 12 is 3,000. So that is going to be your monthly rent. That is how you calculate the rent in this particular example. Okay? You be aware. You are going to pay in this particular fashion your electricity, your internet, your telephone, water, and garbage. Careful, careful, careful. Okay? Next one. This one is called full service gross. And again, at the bottom, you see the wonderful word restaurants. And in this case, the tenant pays 1 fee to the landlord, and the landlord pays for any and all expenses. You give the guy 3,000 and forget about garbage, forget about electricity, forget about water, forget about CAM, forget about property taxes. 3,000, kiss goodbye. Okay? In this instance, the landlord puts this kind of lease in, I'm sorry to say, but in a low quality restaurants. I'm talking about probably C type of building or 2-star type of building. Remember, the buildings are classified by stars or by class. Class A is the most wonderful, beautiful restaurant you can imagine, with service at the door, concierge. They take your coat at the door. They have full service, 3-star Michelin, $250 every time that you go there. That's an A class. And then the B and the C, as you can imagine, goes lower and lower and lower until the one that they give you a stick for the animals that might have in the restaurants. Okay, so be careful about that. And of course, we have to use our imagination, and the modified gross is exactly the combination of the above. This is something that, again, your commercial realtor with you first are going to see and say, okay, I want to negotiate the water, I want to negotiate the camp, I want to negotiate the electricity, for instance. You pay the electricity, I pay the water, etc. Everything is negotiable in this type of lease. Okay. Next. Let's say other elements to consider when renting. Very, 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 very important. And again, I'm very sorry, guys, but only commercial realtor knows about these secrets. This is very interesting secrets. Tenant improvements. You remember this guy here? Well, how about if we ask the landlord to give us $20,000? Why? Because we're going to put equipment, we're going to change the floor, and we're going to put other kinds of, let's say, walk-in, etc. We're going to modify the wall. So then we're going to ask him for X amount of money. Or if the guy doesn't want to give you money, how about 3 months rent? Free rent. Remember, the taxes have to be paid every month. So the only thing that he will pardon you in a technical words, abatement or abatement or free or discounted is the base. The base rent is not going to be collectible, but it comes, unfortunately, we have to pay to Uncle Sam the property taxes. So you will be responsible to pay property taxes or come only for the 3 months that he is giving you free rent. In the tenant improvements, careful. Second paragraph is not free money. It is something that the landlord will help you with, but guess what is going to happen? It's going to be divided by the number of months that the lease agreement was signed for. In other words, if he gave you $100,000 and the lease is for 5 years, guess what? He's going to collect $20,000 a year divided by 12, something like 1,400 a month, in addition to the base and the camp. So be very careful with your budget here, okay? Tenant improvements is not free money. Free rent is free rent, but it's only to the base, okay? Careful here. Negotiable 100%. Now let's talk a little bit about how we can supervise, control, and improve our restaurants. And I wrote here, guys, 5 different metrics, but there are 20, 25 different metrics to the point in which you can control and determine what is the efficiency per square foot of your restaurant. How you are going to control each tomato, each onion. You can do that, you can control that. There is software for that. The 3-star Michelin restaurants do that. They control each garlic, each tomato, each asparagus. So if you are not doing that because you are not 3-star Michelin, at least start to control your inventory as a whole, okay? And the first one is cost, which is the cost of goods sold. A good one is 20%, 40%, depending upon if you are in a bar or you are including a bar in your restaurant. The other one, very, very important, I have seen restaurants that have 9 people and there are 4 customers. That is ludicrous. You have to be very careful how many people are you going to put in the restaurant for peak hours, for Saturdays, etc. You can have part-time workers. And again, here is very interesting. It's very simple to calculate. It is labor divided by sales. Simple. Okay. A good one should be between 20 to 35. And I even put an example here. You spend in your payroll 22,000. Your labor costs 5. Well, your cost percentage of labor is 25%. 25 is in the middle of 20 to 35. So this particular case, restaurant is healthy in terms of labor, okay? The next one is margin contribution or contribution margin. This is very, 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 very important to calculate per dish. You might have 10, 20, 30 dishes, but how much each dish is contributing to your profit? You have to determine that, my friends. You say, well, you know, the sales are okay, but the tomatoes are rotten because I don't sell enough salsa, or I don't sell enough sauce, tomato sauce. Well, you have to change or the menu or buy less tomatoes. Simple. But you have to start controlling that. Okay, selling price minus cost of ingredients is very, very simple. That metrics. Break-even point is another very important. Believe me, I think that less than 10% of restaurants do that in a normal, consistent basis. In my personal opinion, being an accountant and being a realtor, this should be done at least once a month. And now that we have inflation, now that we have the next transparency that I want to show you, every 15 days I would do it, if I was the owner of a restaurant, of course. Food percentage, food cost percentage, again, is how much food is contributing to the cost and to the profits, okay? That's the number 5. And finally, let's talk about the last 2 years of inflation. If you can see this graph in detail, let me tell you that the veggies and the salads have increased 62% cost price for a restaurant. I'm not talking you in the supermarket. This is for restaurant approach. If you are a restaurant owner and if you were buying eggs, lettuce, strawberries, etc., 2 years ago it was 10, right now is 16.50. That is how much it has increased. The other one is the cheese. The other one is the beef, of course. And then the bakery goods or pastry. And if you put all these numbers into average, in 2 years, my friends, all the raw materials for making a dish have increased 22%, which is the last figure. With that, I think that it's been a lot of information in 50 plus minutes. I really appreciate your presence here. I hope that you learned something new. And here's me my information. If you have any question, I'm here to help you. And thank you very much, Fabio, for the invitation. It's been a pleasure, and I'm always here to help and participate in this kind of webinars.
No, thank you so much, Luis. If anybody on the audience has any questions, just type it in the chat, and we'll probably take a minute or two since we started late. But we, at the Chamber of Commerce, we appreciate your participation. And, you know, really, after going through all this information that Luis presented, it's eye-opening, especially if you are really serious in terms of going into the restaurant industry. You know, as Latinos, we usually like, oh, we think about a restaurant and we'll make some tacos and some empanadas and blah. But hey, how many times have you looked at the cost of the tomatoes and the onions and all that stuff as a percentage of your sales? Believe me, the more traditional American restaurant chains do that every week, and they go into their accounting and they figure out, you know, how much is everything in a dish and how much, as Luis is saying, how much is that contributing to the profit. I used to work way back then in a corporate office of a big chain here, and we did that. I mean, we had to analyze all the menus and say, hey, how much is this really costing, and how much would the price to the customer should be in order to be profitable. And I see that in some of our Latino restaurants that, we just open up something and, hey, whatever price, whatever people's paying, that should be okay. We need to be more formal. And I'm glad that Luis is bringing all this information up, because we need to be more formal in the accounting of any restaurants. It doesn't matter how small it is. We just need to make sure that we're not leaving money on the table. But anyways, if there is any questions, please send it over. I will be putting the link of the recording of this webinar on our website. And also I want to invite you to the next one, which will be in Spanish in a couple of weeks. I will be sending some reminders. This will be the Spanish version of it. We're probably gonna go through kind of the same information, but obviously in Spanish. So if you know of anybody that is planning to open up a restaurant, or he or she wants to invest in the restaurant, they need to listen to this webinar. They need to listen to Luis's opinions, not advices, but opinions on what we need, what it should be done prior to make a big decision like that. So I appreciate your participation. I hope I can see you next time on our next one for restaurants, and please stay tuned for the other ones.
2 shots.
Do we have any questions
Oh,
on the chats? No, I don't.
2 shots. Okay, I'm sorry, yeah, everybody was aware.
Yeah, there were some messages on the chat, but they were not questions. So by now I would just thank you. Thank again everybody that connected, and I will hope to see you the next time. Thank you, Luis, for helping us out.
Very, very welcome, Fabio, as always, it's a pleasure.
Okay, have a good day.
Bye.
Bye.
Okay. Oh man, this is very interesting.